Hey, I'm Alex.
And I'm Emma from Dual Stocks.
Oracle just burned through $24 billion of free cash flow in a single year, while carrying an ROIC that looks almost too good to be true. So today we're not asking who's growing faster. We're asking who can actually survive their own balance sheet.
This is our SDR Resilience Report. The Fundamental Resilience Index scored 0 to 100. Palantir scores a perfect 100. High Resilience, 0 penalty. Oracle scores 65, moderate resilience, with a 10-point penalty applied. Let's look at the 4 components. Cash to debt coverage. Oracle's cash plus operating cash flow covers its debt 8.79 times over. That part is actually strong. Investment self-sufficiency is where it falls apart. That's free cash flow divided by CAPEX. Palantir sits at 62 times. It fully self-funds its own growth. Oracle is at negative 0.43 times. It's spending far more on CAPEX than its operations generate. Earnings quality ratio. Cash flow from operations over operating income. Both companies actually pass here. Oracle 1.55, Palantir 1.51. Both convert accounting profit into real cash. And liquidity runway, cash relative to burn rate, is effectively infinite for both companies. No near-term cash crisis for either one.
So where does that 10-point penalty actually come from? It's our consistency matrix, an internal conflict check across 3 pairs of metrics. Growth versus FCF. Both companies pass, no conflict. Debt versus cash. Both pass, no conflict either. The conflict is ROIC versus Sloan ratio. Oracle's ROIC looks incredible at 83.9%, but its Sloan ratio sits at 14.1%, which our model flags as a sign of earnings inflation. When a high return metric and a high accrual risk metric show up together, that's exactly the kind of internal contradiction the FRI is built to catch. And it's what drags Oracle down from a base score of 75 to a final 65. Palantir has 0 conflicts anywhere in the matrix. Growth, FCF, ROIC, Sloan, debt, cash. Every single check comes back clean. That's the real difference between a 65 and a perfect 100. It's not one bad number. It's an internal contradiction Oracle's own accounting is telling us to watch.
Bottom line, Oracle's massive CAPEX spend, most likely tied to its AI data center build-out, is the real story behind this resilience gap. And that's really the whole point of resilience investing. Growth without a survival check is just a story someone's telling you. Numbers either back it up or they don't. Full metric breakdown, every formula, every raw number. Dualstocks.com/dual/ORCL-versus-PLTR. Next week, Lam Research versus KLA. Hit like if this was useful.